Ever wonder how financial analysts predict the price of gold against the US dollar, also known as XAU-USD? Well, strap in, folks, because we're about to embark on a journey to the world of technical analysis. Technical analysis is a trading discipline that seeks to predict future price movements by examining historical data. It's like being a financial detective, looking for patterns and clues in the charts to forecast where the price might head next. And when it comes to the XAU-USD market, technical analysis is instrumental in navigating its ebbs and flows. In this video, we're going to break down how to conduct a technical analysis on a one-day time frame XAU-USD chart. We'll walk you through each step, from understanding the basics of XAU-USD charts to identifying trends, pinpointing support and resistance levels, and utilizing technical indicators. Before diving deep, remember that technical analysis does not guarantee 100% accuracy, but it dramatically increases your chances of making profitable trades. To start off, understanding the basics of XAU-USD charts is essential. At first glance, a chart might seem like a web of lines, bars, and colors, but once you break it down, it's actually a simple and effective tool for tracking the performance of XAU-USD or gold against the US dollar over time. Let's begin with the concept of a one-day time frame. In the realm of XAU-USD charts, a one-day time frame signifies that each point, bar, or candlestick on the chart represents one full day of trading. This is a popular choice among traders as it provides a comprehensive view of the market trends without the noise of intraday price fluctuations. Moving on, let's decode the basics of reading charts. The chart is essentially a graphical representation of price movements, with the y-axis and the x-axis serving as the backbone of this representation. The y-axis, running vertically, represents the price of gold in terms of the US dollar. The higher up we go on the y-axis, the higher the price. On the other hand, the x-axis, running horizontally, represents time. As we move from left to right, we're moving forward in time. Each point along this axis corresponds to a specific day. Now on to the star of the show, the candlestick. Each candlestick on the chart represents one day of trading. The color of the candlestick indicates whether the price increased or decreased during that day. If the candlestick is green, it means the closing price was higher than the opening price. Conversely, a red candlestick indicates the closing price was lower than the opening price. The thin lines extending from the top and bottom of the candlestick, known as shadows or wicks, represent the highest and lowest prices during that day of trading. So with these basics in your arsenal, you're well on your way to understanding XAU-USD charts. Now you know how to read a chart, let's dive into the actual technical analysis. The first step in technical analysis is identifying trends. Now, when we talk about trends, we're referring to the general direction in which the market is moving. In the world of XAU-USD charts, these trends can be upwards, downwards, or sideways. So, how do we distinguish between these trends? Well, an uptrend is characterized by higher highs and higher lows. This is when the price of gold, represented by XAU, is increasing against the US dollar. If you were to draw a line connecting the lows on the chart, it would generally slope upwards. This is often seen as a bullish indicator, suggesting that it might be a good time to buy. On the flip side, a downtrend is marked by lower highs and lower lows, where the price of gold is decreasing against the US dollar. If you connect the highs on the chart, the line would slope downwards, indicating a bearish market. This could possibly suggest a good time to sell. Now, why are trends so important, you ask? Trends give us a sense of direction. They provide a roadmap of sorts, indicating where the market has been and quite possibly where it might be heading. By understanding the direction of the trend, we can make informed predictions about future price movements. But remember, trends don't last forever. They can reverse at any time. This is why it's crucial to keep an eye on trend changes. A change in trend could signal a potential trading opportunity. It's also worth noting that the longer the time frame, the more reliable the trend. A trend that's visible on a one-day chart is likely to be stronger and more significant than a trend on a one-hour chart. In closing, remember this golden rule of technical analysis. Trends are your friends in the world of technical analysis. They give you the overall direction of the market. The ability to accurately identify and interpret trends can be a game changer in your trading journey. So stay sharp, keep practicing, and let the trends guide your way. Next, we identify support and resistance levels. These are crucial concepts in technical analysis that every trader needs to understand. So what exactly are support and resistance levels? Picture them as invisible barriers on your chart where the price of gold, denoted as XAU, and the US dollar or USD tend to stall or reverse. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Essentially, it's the floor that's preventing the price from falling further. On the flip side, resistance is the ceiling above which price movement struggles to rise. It's a price level where an uptrend can be expected to pause due to a concentration of supply. In simple terms, support and resistance levels are price points on the chart where the laws of supply and demand come into play. Now, how do we identify these levels on the XAU-USD chart? It's not rocket science, but it does require a keen eye. You'll want to look for areas where the price has stopped and changed direction in the past. These are typically your support and resistance levels. Keep in mind that these levels are not set in stone. They're more like zones where the price can hover around before deciding its next move. The more frequently the price touches a level and reverses, the stronger that support or resistance level is considered to be. Why are these levels significant, you ask? Well, they provide potential entry and exit points for trades. For instance, if the price is approaching a support level, it might be a good time to buy, expecting the price to bounce back up. Conversely, if the price is nearing a resistance level, it might be wise to sell, anticipating the price will retreat. But remember, while these levels can give us a good idea about potential price reversals, they're not foolproof. Sometimes the price can break through these levels, indicating a potential shift in the market sentiment. Support and resistance levels act like invisible barriers in the market. They're key to predicting where prices might bounce or break. They're the foundation of any technical analysis and a vital tool in your trading arsenal. Now it's time to utilize technical indicators. In the realm of technical analysis, these indicators are like the secret weapons in your trading arsenal. They're mathematical calculations that use price and volume data to help you understand what's happening in the market and, more importantly, what's likely to happen next. Let's start with one of the most common indicators, the moving averages. Picture them as the smooth road that paints the price action from a bird's eye view. We have two types: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA gives equal weight to all data points, while the EMA gives more weight to recent data. These can help you spot trends and determine if it's an uptrend or a downtrend. Now, moving averages are great for identifying the direction of a trend, but what about the strength of the trend? This is where the Relative Strength Index, or RSI, comes into play. The RSI is a momentum oscillator that measures the speed and change of price movements. If the RSI is above 70, it means the asset might be overbought, and if it's below 30, it might be oversold. Remember, these are just two of the many indicators available to traders. Others include the MACD, which can help identify potential buy and sell signals, or the Bollinger Bands, which can give insights into the volatility of an asset. But here's the thing, no indicator is foolproof. They're not crystal balls that predict the future with absolute certainty. They're tools that, when used correctly, can give you a better understanding of the market and help you make more informed decisions, so don't rely on just one indicator. Use them together, understand what they're telling you, and always keep an eye on the market conditions. Technical indicators are your tools for making more accurate predictions. They add another layer of depth to your analysis. Now, it's time to put everything together. We've traversed a path of discovery, starting with understanding the intricacies of XAU-USD charts. We've learned how to read these charts and how they can serve as a roadmap to the financial world. Next, we ventured into the realm of identifying trends. We've understood that trends are the backbone of technical analysis, helping us to predict future price movements. We've seen how trends, whether upward, downward, or sideways, can be a trader's best friend. From there, we moved on to recognizing support and resistance levels. These levels are like invisible barriers that prices have a hard time breaking through. They play a vital role in making informed trading decisions. Finally, we delved into the world of technical indicators. These tools, when used correctly, can provide valuable insights into market dynamics. With these steps, you're now equipped to conduct your own technical analysis of ZAL USD charts. Remember, practice makes perfect,